So let's go ahead and take a look at what's probable in the market. So this is something that I, in my capacity here as market risk VP, I think in terms of probability, and I think in terms of what I can understand in probability as a lead driver and how I'm looking at markets and how I can affect better decisions across the organization for investors. And I do see in probable in 23 is that interest rates are likely to stabilize. Interest rates, rising interest rates, they've been a headline since early in the summer and continue to be so. And in fact, yesterday, Chairman Powell was up talking about reducing the how much the raise was going to be in December potentially, and that they will soon be pulling back in the Fed funds rate and how much they're raising it. That is very good news. Certainly the equity markets responded well to it. And for us here at Ground Floor, our investors, our borrowers, we certainly see that stabilization of interest rates in Q3 would be a benefit both to borrowers. It would be a signal to the markets that sort of perhaps a bottom in rates is in, and probably a signal to first-time home buyers to increase their looking and affordability coming in more relative to probably where it should be. Also, as I look ahead, inflation clearly was the catalyst for all of the motion in the market, all of the headlines. It was the reason why Chairman Powell began to raise rates, and it's what created a lot of the headlines in the news. So when I'm considering, what's probable, I would look at inflation in 2023 from an investor standpoint and say, where do I think inflation is going to be? Is the Fed going to be successful in taming inflation? Well, I do know this. They will not stop raising rates until it is tamed. So we know that that's probable. And by recent data, we can understand that the beginning of this reducing of inflation has most likely begun, and time will tell. But for me, probability suggests that by the end of Q4, we should see the inflation rate being near target or headed that way. So, as investors, what does that tell us? As investors and borrowers and market participants, what does this tell us? Well, it tells us that the roller coaster that we saw in 22 and will probably likely persist through Q1 of 23 is likely to normalize. And in a normalized market, we can make better decisions. From the borrower standpoint, the borrower can make acquisitions, make informed acquisitions with an understanding of where their ARV is going to be in a much better way when interest rates are in check and inflation has been tamed. Certainly, we could see unemployment rear its ugly head in 23, and that could change the outlook. But certainly, taming of inflation gives borrowers, investors, market participants a much more normalized viewpoint from market terms.